And we have about 3 weeks remaining. Okay? And so far we've been dealing with mostly capital budgeting and capital structure. Okay? So I'm sure you've had enough of those capital structure and cost of whatever, okay? Cost of capital. So the two remaining chapters, chapter 20 and 21, okay, deal with derivatives, okay? And also the risk, managing financial company, corporate finance using derivatives and managing risk using derivatives. Okay? So these topics are supposed to be a little more interesting. Okay? What are derivatives? Anybody know? Yeah, here's the answer. What's derivative in Korean? 파생상품. Yeah, that's good. Yeah, okay. Yeah, so derivatives refer to some financial instrument, value of which is derived from another asset. Yeah? So the value of this particular financial instrument depends on another asset. Okay? Assets include stocks and bonds and mortgages and currency or commodity like corn or pork bellies and all kinds of things, oil. Okay? So when this asset value changes, the value of these derivatives also change. Okay? That's the idea of derivatives. Okay? So derivatives include options, forwards, futures, convertible securities, warrants, rights, and swaps, all kinds of things. Okay? And I have to give you some understanding here, precaution. You're not going to learn how to invest in derivatives in this class. Okay? If you want to learn how to invest or make money using derivatives, you have to take a separate course. Okay? I believe Professor Eugene, okay? And he is the expert, and he teaches the separate derivatives course. Okay? So this course, this is a corporate finance course. Okay? So you will be introduced to concepts of derivatives, okay? And how companies manage their finances using derivatives. Okay? So those are the things that you need to understand and that you will learn in this course. Okay? Okay, so those are the introductions. Okay? So mostly we'll talk about option, many times in this chapter and the next chapter. Okay? And option, the concept of option is, the option gives a right to purchase or sell, okay, to the holder of option. Okay? Right to sell or buy. Okay? The right to buy is a call option. Right to sell is put option. Okay? But the thing is, there is no obligation to buy or sell. So if you hold an option, you really have an option, right? If you want, you can buy or you can sell, right? But you don't have to, right? Depending on the market situation, you can just let it expire. Options have expiration date, okay? And so you can either exercise it before the expiration or on the day of expiration, right? Or you can just let it expire. It's up to you. It's your option. Okay? There are similar concepts like forwards and futures. Okay? They are kind of different from option. Okay? Forwards you have right to buy or sell, but then the other party has obligation, or you also have obligation to buy. So when you purchase this forward, you cannot let it expire. On the day of exercise, the interaction or transaction will happen actually. Right? That's the idea of forwards. Futures are very similar to forward, but the futures are kind of standardized amount of the forwards. So actually, in the next chapter, in chapter 21, we're going to talk about forwards and futures. But I'm sure you have heard a lot about this options and forwards and futures. So these derivatives, like option, has been created to reduce risk in trading. And frequently in the commodity trading situation. So let's say you are a farmer and you're growing corn or bean, whatever. And when you start this farming in the year, let's say early in the spring, you have no idea what it's going to turn out like in the fall, in September, whenever the harvest season comes. So there is a risk, right? Again, risk means uncertainty, right? So farming business has uncertainty, and farmers may try to reduce the risk or eliminate the risk, right? In order to reduce the risk or eliminate the risk, they can get into this option or futures or forwards contract. So you can say it's an insurance. So here's an example here. Suppose you are an exporter. You are exporting something to other countries. And the thing is, once you ship your product, it takes some time for this, the cargo vessel, cargo ship to arrive to the other continent, say America or somewhere. And when the purchaser, your customer, receives the product, they may have a couple of months or maybe 3 months until they actually make the payments. So you ship your product now, but the payment day is 3 months away. And the thing is, there is an exchange rate. And let's say today $1 million, $1 is 1,100 won. Exchange rate. Then if you sold $1 million worth of products, that once you receive the money in dollar and convert it into Korean won, right? That becomes 1.1 billion won. 1.1 billion won. But depending on the exchange rate, right? You can either have advantage or disadvantage. If the Korean won appreciates, is it good for you or bad for you if you're an exporter? If the Korean currency appreciates. You know the concept of appreciation, right? Huh? It's not good for exporters, right? Right. So if $1 converts to 1,100 won, appreciation means Korean won becomes stronger, right? So maybe it goes to 1,000 instead of 1,100, right? So that means previously you had to pay 1,100 wons to purchase $1, right? But now it costs only 1,000 won, right? Which is good for people like me. I get paid in Korean won, and send some money to the United States, right? So appreciation, Korean won appreciating is good for me, right? But if you're an exporter, right, you get, what is it, $1 million, right? $1 million. And you need to convert it into Korean won, right? Then when the Korean currency appreciates, right, that means it is now only 1 billion won, right? It used to be 1.1 billion won, right? Now it becomes only 1 billion won, right? So every time the Korean currency appreciates by one won, okay, you lose what, 1,000. You lose money, right? You lose 1 million won. Is that right? Yeah, because you've sold $1 million worth of the product, right? So it's a risk, it's uncertainty, right? So in order to eliminate the risk, this exporter can purchase option or forward, currency forward. Okay? And what it does is you pay a small fee, okay, to someone who sells this option, or write the same thing, right? Okay? In the options trading, writing an option means selling an option, right? So somebody who writes the option, you pay a small fee and purchase this option, right? Then in this case, you will purchase put option, right? And put option gives you the right to sell, right? Sell US dollar, right? To the person who wrote your option, right? At 1,101, no matter what the exchange rate is. Okay? So you will have the expiration date for this option. Okay? Maybe you purchase 3 months option because your payment day is about 3 months. Okay? And until the expiration day, or on the expiration day, right? Doesn't matter what the actual exchange rate is. Exchange rate may went down to 1,001, which means Korean currency has appreciated. But still, you have a right to sell that $1 million US dollar at 1,101, right? So your receipt or revenue is guaranteed. Okay? But for that guarantee, you will pay a small fee, the price for option, right? So it's like insurance, right? Fire insurance or car insurance. When you buy insurance, right? You pay a small fee, premium, right? But in case you get into an accident, or in case your house catch fire, insurance company will compensate, right, for the price of the car or price of the house, right? So it's nothing but an insurance. You can understand it easily that way, right? So, I mean, this has been created by the traders, farmers, okay? But it has seen a lot of development. There are lots of all kinds of derivatives now. Okay? One thing you have to keep in mind is derivative trading is blamed for increasing the risk in financial markets. Derivative trading is considered very risky. Okay? It's not only risky for the people who engage in the trading, but recently in 2008, we've seen a huge market meltdown, right? Economy going into almost depression, right? Because of this derivative problem. Okay?